Hello and welcome. You are joining us live for the Investor Lab, the home of passionate people seeking a life for freedom, choice, and abundance. And Gabby has got a strained muscle in her neck. Hello, Kim Powell. Great to see you, Kim.
That was rough. Hello, Kim Powell. Hello, Matthew Pitt. Hello, Jared. Hello,
Jared.
Rich
Hey,
Weber. Good morning.
Good
Afternoon. Hello.
Is your neck okay, Gabby?
Dude, I am multitasking so hard, and my neck is not good, and I'm ignoring it.
Okay, good.
I called you dude again. That's so funny. Sorry. Dude, bro.
Need more candlelit dinners, I think.
Yeah, true. Let's have a date night.
Anyway, hey Bex, good to see you. All right, let's get stuck into it.
Hey,
let's not dilly dally, because today is a very exciting topic. This topic came about because in the Investor Lab community, of which, hang on a second, sorry, I don't know what you're laughing at.
Catherine, that's so good.
I just said to my husband, "Oh, the Desktop podcast is starting." And said, "Is that when Goose talks and Gabby only gets to make faces?"
That's
Gabby's going to do
correct,
some talking,
Catherine.
Yeah,
am I going to talk?
Gabby, yeah, you're going to talk in a sec. You're going to be, you're the policy
this
queen.
Is,
you know all about policy.
I guess this is what podcasting is. It requires a person to speak with their voice. So
yes.
We're dilly-dallying. We tried not to.
Dilly-dallying, right? We're not trying not to, right? So today's question was actually inspired by a comment in the Investor Lab community. And there's a link to the Investor Lab community in the description below. So go there, check it out. It is free. Join a community of like-minded people who are creating a life of freedom, choice, and abundance for themselves and their family. So it was inspired by a comment by one of our community members, Braden Warhurst. He was talking about the home guarantee scheme. And
yes.
I'll be honest. I hadn't really been thinking about it very much. I was like, yeah. I mean, because from my point of view, I try not to get lost in all the policy nonsense. You know, like there's always coming up with stuff, and half the time it happens, and half the time it doesn't. And I don't know. You just get on with it, right? Because I sort of have a very macro view. But it did actually get me thinking, and has spawned some very, very interesting insight. I'm very excited about today's episode because I went full nerdburger. I went full beaker mode and really nerded out over this. And so I'm really excited to dig into some chunky and unique ways to look at all of this. But before we do that, Gabby, why don't you set us up? What are we talking about here? We're talking about the home guarantee scheme. You actually understand the policy side of it way better than I do, because I just look at all the macro and nerded out. So why don't you give us a better understanding of what's going on here?
Look, honestly, you've really exaggerated my understanding of the policy, but I know slightly more than you do because I do slightly more research.
All right.
But the reason we're talking about it is because there's been an announcement in the last week, I think, that they're bringing forward this extension of the first home guarantee scheme from the Albanese government. And this scheme is actually something that's been around since 2020. And I find it interesting because why it's come up in the news at the moment is because they've extended it to, it's going to start on the 1st of October. And I think it was going to be a couple of months later, if not early next year. And why it's more interesting now, and I think more people are talking about it, is because they've actually released all of the caps. So what that means is what they had previously had was there was like income caps. So you can only apply if you earn below a certain income level. There were price caps for different locations and where you're buying based on the property price, only under a certain amount, as well as just volume caps generally. So I can't remember the volumes, but they had a certain amount of, this is how many we are going to.
It was pretty low. It was like 30,000 to 50,000 or something.
Yeah, it was not that many, but what is changing now is all of those caps are pretty much coming off, except for the price caps. There's still price caps, but they've gone up. So in Sydney, New South Wales kind of metro area, that's up to 1.5 million.
From like 950 or something, wasn't it?
Yeah. And so that's the highest in the country, but all of the caps, all of the price caps in all the different areas around the country have all gone up as well. So that actually expands the potential properties available for that scheme to apply to. But there are no volume caps. There's no income caps anymore. All of these caps have kind of like come off, and they've brought it forward substantially in time. And so why I think we wanted to talk about this is obviously it came up in the community, and I've seen a lot of commentary online about this already, and people can already detect that this is going to have an impact on pricing nationally. But a lot of the commentary that I've seen, it just kind of stops there because people understand they're like, okay, demand goes up, supply doesn't change, that means prices go up, which is definitely what's at playing out here. But there's much more, obviously, if you've listened to the show before, involved in liquidity and everything that goes into um, the kind of economic reality of the world at the moment, and particularly in Australia. And yeah, I just think you've done, you've gone very deep in working out the true impact that this is likely to have. And we just thought it would be interesting to give our perspective on this scheme and what's been changing.
Great, perfect, great setup, right? So I think you covered you covered that well.
There we go.
There we go. You know what's going on. So so I'm not going to dig into everything you said because you covered it off great, right? So
Yeah.
what I want to do is I want to take this from a different angle because I want to explore like what does this actually mean? Go on, Gabby. Yep.
Just before we do, I actually just wanted to preface this as well. It's like I actually personally really struggle with this topic, this concept, because on the surface level, we obviously want to help as many people to buy homes as possible. Like we want people who are lower income or haven't been able to save or whatever. Like you do want people to be able to get into the home. So it's not about saying like those people shouldn't benefit. Obviously, those people getting into houses when they have felt like locked out is a good thing on an emotional level. And I could see you squinting, but it's like I'm just saying this is why I struggle so much with this topic because
No,
from an
so
emotional perspective, it's like I want to be able to help people, but there
no,
are so many consequences.
no, I actually agree with you. No, the only my main contention with what you said is people of a lower income. Actually, what we want is we want people of an average income to be able to buy an average home.
Yeah. Yeah.
This is not about people on low income trying to get on. This is about the fact, and I will dig into some of the numbers later. This is about the fact that it currently takes, on average, 41 years to save for a deposit, based on the average household income and the median property price in Australia, and the average savings rate being 5%. Takes 41 years right now to save for an average deposit for on an average income for the mean property price in Australia, which is about $1 million. That is not like, so we're not talking about like handouts for poor people. We're talking about like average people trying to buy a house.
Yeah.
And before we get stuck into it, I strongly agree with you, Gabby. Like I actually think that from an investment perspective, you're like, hey, number goes up. Cool, like that's good. We can make money. But from a social perspective, this is really problematic because every single thing the government does supports the demand side, but not the supply side. All they ever seem to do is stimulate more demand, whether it's through immigration policies or whether it's through adding more liquidity or giving handouts and doing all this kind of stuff. And they do nothing to fix the supply. And we were talking about this just earlier, like back in the 50s, 60s, and 70s, the Housing Association of Australia or Housing Australia, whatever, they built houses. There was public housing. They built homes. They built shitloads of homes, and that was how people got on the ladder. My grandma, when she was retiring, she was in a housing commission house, and that wasn't like a slum or anything like that. It was just a normal flat that was owned by the housing commission because she couldn't afford a home. All good.
My family too.
And so the answer is build more houses, reduce regulation, create more supply. That's the answer. The answer isn't create more demand into something that is very supply inelastic, which we're going to talk about now. In fact, that's a really good segue to get stuck into this. I will just say one thing, that this policy, and I'm just going to say it now, this policy doesn't appear to be designed to actually help people. It appears to look like it's helping homeowners get onto the market. But if you actually scratch even just 1 millimeter beneath the surface, what you'll actually realize it is the government's de-risking the banks so the banks can lend out more money and make more profit. This has got bugger all to do with helping people. It's got to do with winning votes because it looks like oh, look at this, they're doing something good. It looks good.
Yep.
Right, but it smells bad if you actually look at it. Anyway, let's get stuck into it.
Because even if you just tiny bit was just, even if you read through like the announcements that are being put out, it's all very political, right? It's all very much focused on helping more homeowners get into the market, whereas a large reason that they can't get in is because of actions from the government anyway. But digress.
Yeah, we're digressing a little bit, but I think it's still useful because even if you look at the loan structure, okay, so the scheme, we were literally just talking about this before we jumped on air. So the loan structure is that first home buyers can purchase with a 5% deposit, and the government will guarantee the other 15% of a deposit up to a 20% deposit, so an 80% LVR loan. That reduces the need for LMI. So that means LMI is not required to be paid by the buyer, but it doesn't change the loan to an 80% LVR loan.
No.
It is still a 95% LVR loan.
Yeah.
So if you just think about that for a second, so the buyer puts down a 5% deposit and still pays interest on a 95% LVR loan.
Mm-hmm.
So what actually is the point of the government guaranteeing 15% of the deposit to get it to an 80% or to 15% of a 20% deposit? What actually is the point? Well, the point is not actually to do anything for the home buyer except for the reduction in LMI. That goes away, fine. The point is to de-risk the banks. So the banks have like on their kind of like risk management matrix, they're only lending out at 80% LVR, which means they can lend more money.
Yeah.
So we'll dig into this. There's gonna be a lot of numbers that we're gonna be throwing around here. The mean property price in Australia is $1 million, 1,002,000, right? Not the average, the mean, right? So the mean property price in Australia is $1 million. If you bought $1 million property using a 95% LVR loan on a principal and interest basis, which is, I think, how these loans will need to be structured.
You have to pay principal and interest. Yep.
You have to pay principal and interest, right? Then, and if we assume an interest rate of 5.5% for an owner-occupier loan, then the holding cost of that property would be $70,000 a year, a little over, about $72,000 a year to hold that property. Let's call it $70,000 a year to hold that property. Yeah. The average household income in Australia is between $93,000 and $98,000.
Yeah.
I don't know anyone who's saving 75% of their income.
Yeah. And this is to Matt's put in a comment in the chat. If you cannot save for a deposit, how are you going to pay off $1 million mortgage? And that's immediately where my brain went as well, Matt. Thinking through, like, again, the focus of this scheme is to try and help people get in. Surface level, good thing. But if let's say that they're getting up to 1.5 million in Sydney, getting that size loan. Now, obviously, they need to go through serviceability checks with the lenders and everything. So hopefully that, like, if they can service it, then they will get the loan. If they cannot service it, they won't get the loan. But still, it's like, if you haven't been able to save that deposit, where are you going to get that money to then repay the loan? It doesn't seem to make sense to me.
For sure. Now we've got a lot to get through, so I want to move on. But just one quick point: Braden has said in the chat here, and they own 15%. They don't. They don't own 15%. That's a different scheme. That's a shared equity scheme, right? So they don't actually own the 15%. All they're doing, Braden, all the government is doing is guaranteeing the banks the 15%. So if they're de-risking the banks, they're not actually owning any of the equity in the property. So I don't want to deviate too much because we're going to get stuck into it, but I think it's an important point to make. That's
two different schemes.
Two different schemes. What's the name of the other scheme? Just quickly, it's the Help to Buy scheme, and that's the shared equity scheme. So we did dig into that.
Be a whole other conversation.
That's a whole other conversation, and we maybe do another whole other episode on that. But let's get stuck into it because it's some very, very, very important stuff to understand here. We can debate all the policy nuances and stuff to the cows come home. But I want to start with scarcity and why scarcity matters. So I've got a whole bunch of notes. I've got 29 pages of notes here. So if you see me looking at my notes, that's why. Okay. So
I forgot to remember I was going to make a nerd sound effect. I forgot to do that.
Oh yeah. Gabby's discovered sound effects.
Oh wait, what do I have? Sorry. I know that we have so much to get through. Just let me do the sound effect.
Okay. We'll wait for the sound effect. All right. All aboard. We're going. Okay, so why does the scarcity and hardness of an asset matter? Well, scarcity is a foundation of value. an asset that cannot be easily increased in supply resists debasement. Hardness describes how resistant an asset is to supply shocks. The harder an
Mhm.
asset is, the credible it is as a long-term store of value, right? Which is very important to understand. Historically, economies tied to hard money, for example, a gold standard, which has a high stock to flow ratio, enjoyed long periods of stability and trust, while economies tied to softer assets, such as silver or fiat, often experience inflation, collapse, or loss of credibility. Now, we usually think of gold and Bitcoin as hard assets,
Mhm.
but Australian residential property, when measured correctly, is actually one of the hardest assets in the world. So we're going to be talking about a concept called stock to flow ratio. Now, what is a stock to flow ratio? The stock to flow ratio is the relationship between the existing stock of an asset and the amount of new supply entering the market each year. So a higher stock to flow means an asset is more scarce and supply inelastic. For example, a stock to flow ratio of 70 means that it would take 70 years of current annual production to double the existing stock. Okay. If
Yep.
a stock ratio was 50, it would mean that it would require 50 years of the current level of production to double the existing stock. Now, I'll give an example, right? So let's take gold as an example. So there's
Mhm.
roughly 200,000 tons of gold above ground. So that's the stock, 200 to 210,000 tons of gold. So that's the stock of gold. In addition, roughly 3,200 tons of gold are mined every year. That is the flow, right? So there's 200 to 210,000 tons of gold that exists. We're adding about 3,200 tons annually. That
Yep.
is a stock to flow ratio of 63, or a stock growth rate of about 1.5% a year. Now, one of the interesting things about gold is it has had a very consistent stock growth rate, or a stock to flow ratio. So ever since it's been measured, or ever since for all of the records that we've got of gold for thousands of years, as technology has, so the stock above ground has continued to grow, technology's improved, and we've been able to mine better and all of that kind of stuff. But the
Mhm.
growth rate has stayed between about 1.5 or 1.75% a year every year for like thousands of years. So
That's
it's had a
interesting.
stock. It's super interesting, and it's actually got quite a high and quite a stable stock to flow ratio, which is also why gold has been such a good good store of value.
Yep.
Um, I'm going to skip forward a little bit. I could talk about. We don't have a lot of time. I'm going to come back to the. I'm going to come back to the residential property. I was going to talk about Bitcoin, but I won't because I want to save time. But let me give
Yep.
you a really quick story, because I think this is super fascinating. So the context around stock to flow is so interesting to me, because silver has a lower stock to flow ratio than gold. So the stock to flow ratio of silver, let me just check my notes here, is something. So in the about 100 years ago, the silver stock to flow ratio was about 10 to 15. So about, it was about 10 or 15, whereas gold's about 63, right, on average. So gold is a much harder form store of value. Now, India and China were both on a silver standard and not a gold standard. The British
Mm.
Empire was on a gold standard. And so what happened is that when, during the kind of like 1800s and early 1900s and all that kind of stuff, silver supply increased massively. So silver as a store of value got debased through an increase in supply rapidly, because it was much softer, whereas gold held its value, which meant that economically the British Empire was able to take control and exert
Mm.
a lot more power and influence around the world. That's a large reason why the British Empire actually proliferated in the way that it did, was because it was on a gold standard, whereas other countries weren't. So there's
Mm.
so much really interesting stuff around that. But anyway, back to the main event. So I was thinking about this, and I was like, what is the stock to flow ratio of Australian residential real estate? Let me know in the chat if you want to have a guess. What do you think it
Ooh,
is?
I'd love to hear guesses.
Love to hear your guesses. What do you think, if the stock to flow of gold is 63? What is the stock to flow of Australian residential real estate? Well, it's not going to come through because there's a bit of lag. So I'm going to wait. I'm going to keep going. The stock to flow ratio of Australian residential property in 2016 was the growth rate was 2.1% a year, and the stock to flow ratio was 48. In 2025, the stock growth rate is about 1.4% a year, and the stock to flow ratio is 70. Let me show you a graph so that it makes sense.
Yay.
Do, 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 do.
Multitasking.
I just hate that you can't double click on the thing. Okay, so can you see my screen?
Yep.
Okay, so this is the stock to flow ratio of Australian residential real estate over the last 10 years. So you can see that it started at about 48 and then it shot up to, I think, about 73, and it's now at about 70. If we compare that to gold, gold has a stock to flow ratio at 63. So 2020 or FY 2020, late 2020, real estate in Australia became scarcer and harder than gold, which is very, very interesting. It also means that at the current growth rate, it would take 70 years at the current growth rate of stock versus the current versus supply for the amount of properties in Australia to double, which is huge. Now, what this actually means is that new supply has materially slowed over the decade while stock has continued to rise with population, and scarcity has increased. Now,
Yeah.
you can see here, this is the stock to flow ratio versus population in Australia over the last 10 years. And you can see the population has been massively increasing and the stock to flow and the asset class of Australian residential real estate has been hardening. That is what this means. When the number goes up, the asset gets harder. Now, I actually do have the stock to flow ratio of Bitcoin would it be interesting and useful to kind of compare Bitcoin, gold, and real estate just to give it a context? Or
I
not?
think it would. Yeah. Yeah.
Right, cool. All right, give me.
While you're getting that, I just want to shout out. So Bex has shared thinking about all the building company collapses during that time. Totally. You think about 2020 to now, how much supply has been impacted from those closures. Like it's obviously definitely having an impact on this ratio.
Yeah. Definitely. Sorry. Give me.
Need more sound effects.
Yeah, we need more sound effects. You know what? I'll post it in the community. One of the things, I can tell you, I can't find the visual very easily. So what I'll do is I'll post it in the Investor Lab community later on today. But I can tell you that the stock to flow ratio of Bitcoin in 2016 was 12. In 2018, it was 25. In 2020 to 2023, it was 56. And in 2025, it's 119. So it has gone because the block rewards have been getting smaller, and so the new supply coming onto the market versus the existing stock is going down, and so Bitcoin is getting harder, real estate is getting harder, gold is staying about just as hard. So you can see that population has been increasing, whilst the stock to flow ratio in real estate in Australia has also been increasing. Now, this is also super interesting to check out here. Because this is the stock to flow ratio versus dwellings per 1,000 people from 2016 to 2025, last 10 years. So you can see that the number of dwellings per people, number of dwellings per 1,000 people in Australia was, reasonably high and fairly consistent, right? And then we hit 2021, migration went through the roof at the same time that the stock to flow ratio was increasing. What that has created is a massive divergence between the two, huge disparity. This is why we have a housing crisis, right? The number of houses per 1,000 people has crashed because the number of people has gone up, but the new supply coming onto the market of houses is diminished, and the asset has been getting harder over time. So this is really an important thing to understand, because even without policy interventions, structural scarcity is getting worse, right? So. And also, supply is falling behind population growth, basically, right? So, is this all making sense, Gabby? Is this all making sense to you guys in the chat as well?
Yeah, it's making sense. I was just thinking about going back to Bex's previous comment. I was thinking about, imagine if in that period, like 2020, 2021, obviously we know everything that was happening in the world at that point, but if they had to focus on fixing supply, then we may have skipped this whole housing crisis entirely.
Well, yeah. So we're gonna come back to that, right? So now so what we've established there is that Australian residential real estate is now scarcer and harder than gold, and we have a tremendous population growth. We have a population growth rate of about 1.7%, and we have a housing supply growth rate of about 1.4%. Okay, so that gets harder and harder. And you look like something's happening there, Gabby. Is everything okay?
That's right. There's a weird sound of it. It's all good.
Okay, so population growth is roughly about 1.7% per annum at the moment. Housing supply growth is about 1.4% per annum at the moment. So population growth is outstripping housing supply. That means dwellings per 1,000 people is continuing to go down, and that is also the supply of real estate versus the stock is actually staying low as well, which is why residential real estate is harder than gold. Okay, we've established all that. It's a very scarce asset. So along comes the home guarantee scheme, which, to your point, is not a new scheme, but they've expanded it and they've changed it, they've revamped it, they've reduced it, and now they're pushing it out. So what this actually means is, and as you mentioned, there's no income caps, there's no limit on the number of places. They've increased the maximum purchase price on properties, and the minimum deposit is now just 5%. In fact, is 2% for single parents under the family home guarantee, right? So there's actually another little carve out there as well, which, I'm emotionally very for supporting single parents as well. So I think that's a good idea. Now, the government doesn't take equity. It's a credit guarantee only. So they're backstopping the banks. So what does this actually mean? Okay, so we've got the government saying, hey, they're going to launch this program. Buyers can put down a 5% deposit. First-time buyers can put down a 5% deposit. The government is going to backstop the banks so the banks can lend out more money. So what is actually happening? They're not giving money to the first-time buyers. They are allowing the banks to create more credit. So what is that? That is extra liquidity that floods into the system. Now, the Treasury has no, close your ears if you don't like swearing. The Treasury has no fucking clue what they are doing, right? They are talking about the fact that this could inject a maximum of $10 billion into the economy, and that it may increase property prices by 0.5%. This is their actual forecast, that it may increase property prices by 0.5%. However, what this is likely to do is introduce another 20,000 to 40,000 buyers into the market who weren't able to get into the market prior, right? So it's going to bring that demand forward. I'm going to talk about demand compression in a moment. So that's between 11 billion and 21 billion. Now we can round it down and say 10 to 20 billion, right? They're injecting $20 billion into the market. That's before we take into consideration the LMI. But I want to just talk about the buy side aspect of this. So this is 20,000 to 40,000 additional buyers coming into the market. Now, there's roughly 600,000 property transactions every single year. 20,000 divided by 600,000 is about 3.3%. And 40,000 divided by 600,000 is about 6.6%. So there was some independent modeling done by a company called Lateral Economics. They were commissioned to do an independent study on this. Their research is actually pretty good. Actually, the stuff they've done is actually pretty good. Their base case, which I actually agree with, by the way, is that property prices in the first year nationally will increase by between 3.5% and 6.6% in the first 12 months, in addition to organic demand, right? And so that's in addition
from this scheme. Yeah,
exactly, right? So that's additional growth going into the market, right? And that's through the addition of more buyers into an inelastic supply. So we've already established it's very imagine if the government turned around and said, hey, we're going to give 40,000 people $20 billion and the only thing you can buy is gold. What would happen to gold price? Like, it would go up, assuming that the gold supply was limited only to Australia, for example, right? I guess that's a bit of a difference. But here they're effectively saying we're going to inject $20 billion of capital into the market for 40,000 people to go and buy one asset, just one asset. The only thing you can buy with all of this money is one thing. That is real estate. And real estate is already scarcer than gold. So what is that going to do? The only thing that can do is push prices up. Now, if we also include the LMI savings as part of the total liquidity expansion, the number goes up by about another $1.5 billion a year. So $1.5 billion in year one. So that changes the liquidity dynamic to it's the same amount of buyers, 20,000 to 40,000 buyers. But that would change the liquidity injection from about $12.6 billion to $22.7 billion. So we'll call it $13 to $23 billion in capital being injected into the market, which is absolutely crazy, right? Because what is happening is they're not they're not actually helping buyers to get into the market. There's a dynamic there where if we say the mean property price right now is $1 million, if instantaneously you go throw $20 billion at it, what happens is that price target moves. So people sort of simultaneously get into the market and fall out of the market again because all they're doing is increasing prices, not increasing access and accessibility. Now, the big question here is like, what would you do instead, right? Because there's I've got a lot more to go through as well, by the way. But what would you do instead? Well, if you took $20 billion a year and just said, we're going to build $20 billion of houses every year, that would make a bigger impact on actually creating more supply and bringing the stock to flow ratio down and increasing access to consumers. That would do a lot. That would do a lot better. And guess what? It probably wouldn't actually negatively impact price that much anyway. Because what we're actually talking about doing at the moment is pumping that liquidity in and increasing it above the organic growth rate anyway. If you were to add more supply into the market, that would be soaked up by more people who want to buy. I don't actually think the perpetual bid on the downside of the property market demand is so strong that you would have to add a lot. You would have to add such a huge amount of supply into the market for that to actually cause a price decline because people want it. So the moment that it comes down by 1%, you get 1% more buyers. Like it just sort of tops itself up. Is it all making sense so far?
It is. I wanted to I'm not exactly sure where you're going next, but if we're changing topic, I just wanted to double click on and revisit, I guess, again, so we did an episode at the start of the year, which is a really solid episode, which is all about liquidity. And it did a bit more of a breakdown of like how increased liquidity in the market, like why does that increase house prices? Are you able to give a short revisit on that? Because I think
yes,
it's like, okay, 20 billion is going into the monetary supply, but why does that mean that property prices are going up?
Okay, so I'll give the broad answer and then narrow it down. So based on the quantity theory of money, the value this is not an exact equation, right? But the easiest shorthand way to think about it is that the value of a currency is effectively the total value of all of the goods, assets, and services in a country. It's everything from the service economy through to the iron ore in the ground and all of the commonwealth and all of the land value and all of that. Like it's all the value of all of the stuff that you can spend money on divided by how much money there is, right? So if you take the total value of all of the stuff in a country that you can spend money on and divide it by the amount of money, by the amount of currency in circulation, very broadly, that's the value of the currency. If the value of all of the stuff, or if the amount of things in the country stayed the same, you have the same amount of goods, assets, and services, nothing changed on that side of the ledger, but you doubled the volume of the currency, then you would have twice as many dollars chasing the same amount of goods, assets, and services. And so in nominal terms, that would mean that everything would go up by double. Now, in practice, not everything is going to double in price. And the reason that not everything is going to double in price is because some things are scarcer and harder than others, and some things are more desirable than others. So what you're looking for in terms of like where to put money in an inflationary environment, monetary inflation environment, is scarce, desirable assets, hard, scarce, desirable assets. And so that's why a house will go up more than a toothbrush, right? Toothbrush has like technology-based deflation, and a house is a scarce, hard, desirable asset. And so money doesn't flow equally to all things. It's not like everything would double in value in that equation, because then you've got the supply and demand side of things, right? So if you've got something that has a tremendously high amount of supply and there's not a lot of demand, then it would not double in value, but something that has less supply and a lot of demand would go up more in value. And that's a general rule. So if the government were to print twice as much money, you would see house prices go through the roof, because that is a desirable place for people to go and put their capital. They want to do that. Now, in this specific circumstance, we're not saying that in aggregate, the government is, printing or creating $20 billion of liquidity in aggregate. We're saying that they're creating $20 billion or $23 billion of liquidity only for the property market. So that doesn't get distributed elsewhere. So that doesn't get distributed in some kind of more even way across. It's not going to affect lawnmower prices. It's going to affect property prices only. So you're not going to find some aggregate transfer of that into, say, services. Services costs might not increase, but whereas they potentially would if you double the money supply. And so this is money that's flowing directly and specifically, and they're saying, we're going to give you $20 billion. The only thing you can spend it on is property. And by the way, Australian residential real estate is scarcer than gold. Yeah. So good luck.
By the way, we're not fixing supply. So
yeah, and we're doing nothing to fix the supply. Right.
Yeah,
so
have fun.
Yeah. So now what is really interesting to me about this is actually, okay, so we've established that Australian residential real estate is scarce, hard, desirable, scarcer and harder than gold. We've established that the government has a program that is going to inject, through the function of credit creation by the banks, 20 to $23 billion of liquidity into the market. But the actual thing that's really interesting to me is the fact that it's going to be warping the demand curve. So I'm going to walk you through some maths, right? Because this is actually how this plays out over time, which I think this is really interesting to me, right? So actually, let me take one step back. So we established that nationally, property prices should go up by between 3.3 and 6.6% in the first 12 months. That is nationally. But of course, first-time buyers aren't buying nationally. They're going to buy in certain pockets where they want to live, where the prices match what they're looking for and everything like that. And so if you transfer that to we'll call them in-demand locations, the likely impact is, one moment, is it's basically up to 10%. It's around 10%. So in the actual locations where people are going to buy, it's more like a 10% price growth, in addition to the organic price growth. So let's say that there was 8% organic price growth happening in a location, and then a whole bunch of first-time buyers wanted to buy there, then that may go up to 18%. Right? So this is going to be a significant shifting for a whole bunch of economies. Now, what I want to talk about now, though, is how it's bringing forward the demand, because I think this is really fascinating. It's really fascinating to me. Cool. So I'm going to walk you through some numbers. So the mean dwelling price in Q1 2025 was $1,002,000, $1,002,500. So we'll call it $1 million, right, for simplicity's sake. The median household income is about $93,000 to $98,000. The average savings rate for households in that kind of earning bracket is about 5%. So that means the annual savings capacity is about $4,900 per household.
Is this nationally? Sorry.
Yeah, it's nationally. Yep. If they were to put up a 20% deposit, which emulates what the program is designed to do, because they're guaranteeing the 15% spread, right? That would be a $200,000 deposit for a $1 million home, which basically means that the time to save a deposit would be 41 years on average. So based on the average household income, the average savings rate, the mean dwelling price, the average savings capacity, and the average 20% deposit, it would take you 41 years to save for a standard deposit at the current prices and current savings rates.
That's crazy.
It's so insane. It is so insane. Right. Now, of course, not everyone's putting up 20% deposits, but we're using this as a proxy for what the government is guaranteeing. So they're actually stepping up and saying, we're going to guarantee the spread. So then we have to use a 20% like for like. Okay. Mm-hmm. So now with the home guarantee scheme, the required deposit would be about $50,000, not $200,000. The annual savings rate, we'll keep that at $4,900, which means that the time to save a deposit is about 10 years, 10.2 years roughly. So we're taking it from 40 years to save for a deposit to 10 years to save for a deposit.
Yep. So 4 times as quick.
Yes. And that 4 times ratio is something that's very important to remember. So keep that in your mind. What we are doing is we're compressing the compression rate of the demand. So there's two things. There's the demand curve and the compression rate, right? The compression rate is 4 times. Okay. Now, what is happening now? I ran a few different scenarios on here as well, because that just used kind of like aggregate national averages. But I said, okay, well, what if we just looked at the first home buyer specific cohort and we use that as a kind of working example? So we said, well, the typical home guarantee scheme purchase probably wouldn't be $1 million property. It'd probably be $570,000. Okay. That a 20% deposit for a $570,000 property would be $114,000. A 5% deposit would be $28,500. At a 5% savings rate on a $98,000 income, so $4,900 per annum. So we're assuming the same household income, although you could argue that perhaps the household income would be lower if we're not going to use the national average. But we'll use the national average because we don't know what I couldn't find reliable information on what the average household income would be for first-time buyers. So we're just using the national average, although I would argue that it's probably lower, right? So the time to get a 20% deposit based on a $570,000 property, based on a $4,900 annual savings rate, is 23.3 years, and a 5% deposit is 5.8 years. So that's 23.3 divided by 5.8 equals about 4x. So even if you scale down the property purchase price, you're still compressing.
Still about 4.
It's still a 4x acceleration, right? So because and the reason is you're compressing from a 20% deposit to a 5% deposit. So however you carve up the cake, you're still going from 20% to 5%. So the ratio is still a 4x ratio. Now, here's where it gets really interesting: is the pull forward dynamics. So without this scheme, a lot of people would be locked out of housing indefinitely, because like by the time it's 41 years to save a deposit now, but in 41 years time, it's probably going to be 80 years time. So hey, good luck. You're never going to get there. So this scheme does help a lot of people to get into the housing market sooner. Now, what is interesting is it actually doesn't create more demand. It brings demand forward. Because if you imagine a 41-year time horizon or a 20-year time horizon, whatever you want to use, like whatever numbers you want to use, right? You are actually bringing it forward. You're bringing, say, 20 years of demand forward to 5 years of demand. Okay, so you're going to compress 20 years worth of demand into 5 years by bringing that forward. You're not actually creating new demand. And so the way to think about this is like, imagine you're at a beach, you're at a nice big flat beach, or you're in a sandbox or something like that. If you scraped all of the sand from one side, if you just like got a big scraper and started scraping sand towards yourself, what you would do is you create a mound. You'd still have the same amount of sand in the sandbox, okay? But you'd create this mound because you've actually pulled forward the sand from one side of the sandbox to the other. So you'd have this uneven distribution, right? We're actually bringing all the sand forward. That is what is happening with this program. So it doesn't actually matter whether you measure from 41 years down to 10 or 20 years down to 5 or whatever. The compression is the same. It's about 4 times faster, and you're effectively fast tracking the demand forward by 4x. Okay. Now, what that does is that creates the same upward pressure. So whether it's 20 to 5 or whether it's 40 to 10 or whether it's 100 to 25, it doesn't really matter. The compression factor is still 4x. That's actually what's changing that dynamic. So now the interesting thing is the price impact of this. As I say, the Treasury believes. get this. The Treasury has officially said that they believe the price impact will be approximately 0.5% over 6 years. Great.
Sure.
Yeah, sure. So what this is going to do is this is going to actually, as I mentioned, it's going to increase property prices by about 6.6% nationally in the first year, or 10% in the actual location that the people want to buy. And that's because there's going to be a demand shock because we're bringing all this demand forward. We're scraping forward the sand towards us. We're going to bring a demand shock because we're going to take future demand and we're going to bring it forward to today. So we're going to increase the amount of demand by giving more people access to the market. Into an environment where we're not producing additional supply. Okay, so that's an inelastic supply environment. We're not just going to spontaneously create more houses to fulfill this demand. So, and as I've already spoken about the 600,000 average transactions. So what this actually does. Now, what's interesting about this is, as I said, we're pulling forward 4 times the demand. So whether you use let's use 20 to 5, right? Let's use that as the metric. So we're going to bring 20 years worth of demand forward into 5 years. Now, the modeling that Lateral Economics did is they said, okay, if we have a static amount of buyers, so the Treasury, I don't know what the hell they've done to get to 0.5% price impact over 6 years. Lateral Economics, this is where I think they've completely stuffed up their research. They suggested that if we have a certain amount of first home buyers, they're going to be given access to the market, that they're not all going to buy at the same time, which I agree with. And they modeled a dynamic trailing curve. They said, okay, we're going to have X amount of buyers in year 1, less in year 2, less in year 3, less in year 4, and it was a diminishing curve down to 0. Okay, because they basically said we have a certain amount of first home buyers, they're going to access the market, but they're not all going to access it at the same time. And so eventually we'll run out of them, but it'll just be some kind of trailing off curve.
We'll run out of them. Okay.
We'll run out of them. Yeah, there won't be any more. And eventually, so we'll be fine. The problem with that is it doesn't actually take into consideration the pull forward factor. It assumes that we have one static amount of first home buyers that want to buy, and they'll just distribute over the next, say, 5 years. In actuality, what we're going to have for the next 5 years is we're going to have 4 times the amount of demand each year for the next 5 years. Because if you take 20 years worth of demand and you bring it forward by a factor of 4, then you're going to have 20 years worth of demand in 5 years. So you have 4 times the demand per year over the next 5 years. But that's not where it stops, because of course, what's going to happen is new buyers enter into the first home buyer cohort every single year. Either they grow up, maybe they were 16 and now they're 21, or maybe they were whatever, maybe they were in their early 20s and now they're in their early 30s and they've got a decent enough job to be able to save and whatever, right? So the people that are in the first home buyer cohort, that is going to keep getting replenished. It could be displacement from people that have, had family troubles or whatever, or any number of things. You're going to keep topping up the first home buyer cohort. So it isn't some kind of like one and done sugar hit of like, right, we're just going to do this thing, smash bang, and then it'll trail off. What's actually going to happen is there's going to be 4 times the amount of demand compressed over the next 5 years, combined with the topped up number of people coming into the first home buyer cohort every year, effectively in perpetuity. Now, what that will mean is that there will be some tapering, right? There will be some tapering because what'll happen is you've sort of, if you scrape the sand forward, necessarily in the first bite, there's going to be a lot of people who are like chomping at the bit, ready to go. So you will have more activity in the first year. Then you will typically have less activity in the second year, typically have less activity in the third year, as these things normalize out. Right? This isn't just going to be, it's not like a square graph where we have 4 times demand and it stays flat at 4 times demand for the next 5 years and then it drops off. In actuality, it might be 4 times demand in the first year, 3.5 in the second, 3 in the third, 2.5 in the fourth, and so on. And it probably is going to trail off. Now, the best workings that I've been able to get to on this is that the perpetual bid on this, or the structural shift on this, because of the scheme and the fact there's always going to be new first home buyers entering into the first home buyer cohort, is that in aggregate, they will have elevated the floor of property price by about 3%, between 1% and 3% in perpetuity, as long as they have the program, because that accommodates the fact that more people are going to be coming into the cohort over time. Does that make sense? So you have all these first home buyers now. They're going to get eaten up in some sort of distribution curve over the next 5, 6, or 7 years, right? And also we're going to have new buyers coming into the market at the same time. So then that's going to smooth it out, and then it won't go to 0, but it'll go down to some point where we have sort of between 1% and 3% per annum of new demand coming into the market. Is that crazy to you or what? Like, am I the only one that's like loving this level of nerding out on this?
I find it interesting how it's so, like, what are the Treasury reporting on then? Like, I know you said that you don't know, but it's interesting of like, I mean, again, their announcements are not focusing on long tail effect, right? They're focusing on short tail, getting people into the market. Look how good this is, rather than like, hey, might actually break some stuff.
Oh, it's totally going to break some stuff, right? This is like, and this is part of the problem, right? So the simple act of implementing this scheme means prices go up. So it's just like people fall into it and then they fall out of it at the same time. And as Bex has said here, they're focused on the next election cycle. So, and Catherine, I'm glad you're sticking around for the sound effects. So that's good. And I agree, Blake, the Treasury is on crack. This is one of the, as I said at the start, at first I wasn't really paying a lot of attention to this. I was like, oh yeah, like whatever. I don't know. Had other things on my mind. But then we actually start to really look at this. You go, okay, what is I'll recap on a couple of things, right? So housing stock to flow rose from 48 in 2016 to 70 in 2025. Dwellings per 1,000 fell from 434 to 412, which basically means we're in a supply inelastic market, scarcer than gold. Credit is the main constraint, right? Access to credit and deposits are the main constraint. So the government is backstopping the banks to be able to create an additional $20 billion of liquidity per annum-ish, right? It's not quite that, right? So it's not necessarily going to be 20 billion a year, but they're going to create 20 to 40,000 new buyers in the first. Typically, I think in the first year they're going to create 20 to 40,000 new buyers. that is then going to be compressed into certain markets that are between, say, 450 and 1.5 million. To the average expected price is about $570,000. So that's going to push up the lower price property markets faster, typically by about 10% above the kind of average growth rate. And then, we're going to have a spike, and then it's going to have a trail down to a perpetual kind of like 1 to 3% increase in property price growth above what would be the normal organic rate. So, like, this is like a structural reshaping of the and going back to the point, what would you do instead? I don't know. Like, maybe don't just fund the demand side. Maybe fund the supply side. Maybe reduce building regulations. Maybe change zoning laws. Maybe have a government department that actually goes and builds houses. Maybe do that. Maybe create more properties. So,
yeah, which I found ironic looking at we talked about this before we jumped on, but Housing Australia is obviously the department that used to provide the housing commissions and doing the development back in the 60s. It's the same department now that are holding the guarantee with the lenders through this scheme. So it's like it's there. They know that they have this department that is designed to help affordability, but it's like they're not using it to genuinely fix affordability. They're using it to whatever their objectives are, but it's not like who said it? I can't find the comment now, but about the 4-year political cycles.
Yeah.
It's like I genuinely think, and Braden had a question about like what's in this for the government then, other than tax. And it's like I think with this stuff, a lot of it is just re-election. Like this particular government, the Albanese government, wants some kind of hero story to come out of their term, because people haven't been super stoked with their term lately. And so they're wanting to bring this forward. So it's very much like, hey, look what we did. We helped first homers get in, because it is a very emotional topic. And people, they want to have some kind of positive legacy, regardless of the impact that it will have beyond that term. So,
yeah, totally.
Yeah.
So, and I'm just reviewing some of my notes here. Where I got to in some of my workings was that the demand shock could be around 12 to 28 billion dollars annually. Annually, right? So that's a pretty big bid into the market. Now, the problem with that is it's credit creation, right? It's either money printing if it's the government providing the deposits, or it's credit creation if it's the banks. So what that is actually doing is that's actually devaluing everybody else's currency. And so if you really, really want to get a little, go a little bit further with this, this is like wealth distribution tax. And so they're effectively devaluing the dollar and causing property prices to go up at the same time through both the function of dollar devaluation, although that would be a minor impact in this scenario, and specific demand creation. Like it's just crazy to me that a government would say, here's 20 odd billion dollars, but you can only buy one thing. Like imagine if the US government said, we're going to give every citizen in the US $1,000 and the only thing they could buy is Bitcoin. Imagine what would happen to the price of Bitcoin. It would go through the roof. Like it'd be crazy, right? Now Bitcoin's got a higher stock to flow than Australian property, but the whole premise is just absolutely bonkers, right?
But part of it that I find frustrating is like, because it's the majority of people in this country and just people generally don't understand the basics of money and currency, and the fact that when governments announce these kind of schemes, whether it's related to housing or health or anything else, the funding impacts everyone. Like the funding has to come from somewhere, and more often than not they just create it, and then that impacts everyone, not publicly but silently. It impacts everyone and makes the currency I lost my train of thought, but you know what I'm saying. Like
I know. I know exactly what you're saying, right?
Education gap that tends to be exploited, I think.
Totally. And it's kind of like, it's a really funny position to be in, because like, hey, as property investors and as a, we have a company that helps people to invest in property. And obviously we want our clients to make lots of money and create lots of freedom, choice and abundance and wealth and do all of that kind of stuff. And that's fantastic. And at the same time, I'm sitting here saying, this is a freaking stupid policy decision
Mm-hmm.
because it is only going to force property prices up. Now, there's a bit of a dichotomy there, but you've got you've got a social conscience as well as a desire to make money. But it's a crazy thing to be able to look at an asset that is already exceptional, right? So like already has like so many tailwinds behind it, and then go, the government is just backing up the truck on this and just pouring more and more fuel on the fire. So from an investment perspective, like this is sick, right? Like from an investment perspective, hey, if you have believed in property as an investment, well, guess what? Your belief should have just got a shitload stronger, because this is like they are backing up the truck and just pouring more fuel on the fire. And the fire is already burning out of control. This is like, it is an inferno. And when I say that, it's like there is so much structural underpinning of the Australian property market for it to go up that it's absolutely crazy. Everything from monetary debasement to the increase in they're targeting 1.7% population growth between now and 2032 or 2036, which again is way faster than the building approval rates. So, stock to flow is only going to go up and up and up and up, right? So real estate is getting scarcer. Population is going up. So the demand side is going up, and the supply side relative to the demand is going down. Plus, we've got the great wealth transfer that we've spoken about in a couple of episodes ago, which is so important to consider in all of this. And I'll just quickly touch on this because, again, this is one of the things that nobody's talking about. And I know it's a little bit off topic today, but it's very important. There is roughly, actually, let me quickly get my numbers here.
Yeah, we were looking at it the other day.
Yeah, we were looking at it the other day. So the housing market in Australia is roughly $11.4 trillion. Don't quote me on that. It's not about $11.4 trillion.
There's like 2.3 in debt or something.
So it's 2.4 trillion in debt, right? Which means that there's 8.8 trillion in it means there's 9 trillion in unleveraged equity, right? So there's $9 trillion. So the housing market's worth about 11.4 trillion. The debt on the housing market's worth about 2.4 trillion, which means there's about $9 trillion in unleveraged equity sitting in the Australian residential real estate market, which is crazy. So what happens when the older generation downsizes, dies, passes that wealth on? That wealth gets transferred to the younger generation and to their kids or to their grandkids or whatever, and that wealth gets leveraged. So they may own, for example, a $1.5 million. So let's say somebody passes away and they had a $1.5 million house with no debt on it, gets sold for $1.5 million, and let's forget about taxes and all of that kind of stuff at the moment. If that gets distributed, that $1.5 million could get turned into $7.5 to $10 million of property purchasing power. If 7.5 based on an 80% LVR, by the way, that would create 400% more demand for the property market straight away. It's a 5x, right? So that would be like the equivalent of the Australian property market going from 11 trillion to 55 trillion over the next, I don't know, 10, 20 years? Like that's crazy, right? That's crazy. That's in addition. By the way, that's in addition to the demand side, immigration, the supply side, low building approvals, and in addition to monetary inflation, and in addition to this home guarantee scheme. And that's not even to mention the shared equity one that we'll do a whole another episode on. So this stuff, this is like a very interesting kind of linchpin. And the other factor here is we're in a monetary easing cycle, an interest rate easing cycle. So interest rates are going down, right? They're on a downward trend on top of all of those other things. So there's six different factors in there.
There's so much demand coming. Yeah,
it is so insane, right? And if you just open your eyes and look at it, then it's very hard to paint a picture that you should be doing anything other than. I mean, look, we talk about other stuff on here and in the community. We talk about Bitcoin and equities and all that kind of stuff, but you can't, like let's just say like the case for Nvidia as a company is that every company in the world will buy as many Nvidia chips as they will produce for the next 10 years. Like there are people saying, like Elon Musk has literally said, I will buy every chip you ever make, right? And then there's 100 other people like Elon Musk. So that's like, you go look at that and you go, okay, well, that's a crazy amount of demand for Nvidia chips. It's the same thing with the Australian housing market. It's like people just keeps getting backed up. It's like, what? Like how much crazier can this go? So I think we're entering into a situation. I said it before. I think we're entering into a super cycle. I think that this contributes to that. There's a lot of people that talk about things like, oh, housing market crash. It's like, if you give me a logical argument, give me a logical reason why you think there's going to be a housing market crash, right? Because there isn't
Yeah.
one. In fact, it's short of a black swan event, but even then the housing market would bounce back because of the structural underpinnings.
Yeah. Again, I'm kind of struggling with this because a lot of our conversations that we have, because there's so many factors that are driving this potential super cycle coming.
Yeah.
It's like every conversation, I was trying to think like, what's the recommendation off the back of this episode? Like, what can we leave people with? But it's like, it always comes back to like, if you want to invest and build your wealth, real estate is a really good option right now.
Yeah.
But I keep like, I'm aware that we own a property investing company and it's not even related to that. It's just like based on all of the research that we've been doing and everything that points towards it. And I'm aware that, again, like based on this particular topic, you see a lot of videos out there of people that also may own property investing companies and they go, hey, look, prices are going to go up. So you better get in now.
Buy
and
before
it's like, that gives me the shits because it's like they're correct, but they don't really understand the depths to which they are correct. And again, it's not about like, come and work with our company. It's like, I don't really care if you come and work with our company.
Yeah, but
our
also
company's probably going to get you the best results. But if you want to improve your financial future, like this is a really great option that you should do regardless. Like,
people, talking heads on the internet that are saying, oh, quick, buy a property before October. It's the 29th of August as we're recording this. If you're trying to tell someone to go buy a property before October, like you're an idiot. Like,
I wonder if any of our clients have done that actually. I should check.
Like you can't do it that quickly, right? So you can't do it that quickly and do it well. Like you could quickly go on realestate.com today, find something, put in an offer, off you go. But you don't know what you're doing, right? So rushing is going to cause you to make mistakes. What is important to understand is not, oh my God, there's this thing coming and it's coming in October and it's going to make price. The thing to understand is that for the next 5, 10, or 20 years, there is a structural underpinning that is going to drive property prices up. Now, you need to be on that wave. You need to be on that wave if you want to create more freedom and prosperity for you and your family. Yeah. What you don't need to do is freak out and have an emotional meltdown about it. You should be very committed and very focused on helping you and your family get ahead because the world is changing. So you should have it as a very significant priority to make this a reality in your life, to invest and to get ahead. What you shouldn't do is be forced to have all of these, anxiety attacks because someone else is telling you that, oh, you got to. It's like, no, the world is changing and there is a wave and you can ride that wave. Now, go and get your board and get on the wave. Do it deliberately, do it as quickly as you can, but understand that you can only run your own race at your own speed, and that's it. Now, the fact of the matter is the world is changing significantly. The world over the next 5 years, 6 years, the world's going to change massively. And I would encourage anyone who hasn't checked out the Prosperity Wave Thesis to do so. Go join our community. You can access it in there, or you can check out. I can't remember the title of the episode, but it's got me looking really kooky with a crystal ball beyond 2030, where we talk about what's likely to happen over the next say 20 years.
Yep.
The reality is, investing is not an option anymore. It's a necessity. It's an act of survival for you and your family. Yeah. So you can think whatever you want. You could say that this is actually going to be bad for first-time buyers. You could think that you could think whatever you want. What you actually need to do is decide, how are you going to act? Are you going to stand there, wave your fist in the sky and say, oh, right, this is bad and the government should change? Or are you going to recognize the game that you're in, and are you going to play the game? Because if you play the game, you can create more freedom, more choice, more prosperity, more abundance for you and your family, and you can set yourself up to actually transition through all of the changes that are going to happen well and wealthy. And that is important. You have an obligation to yourself and the people around you to make the most of these opportunities. This is not normal. The things we're going through are not normal. This is not this is not something that is, we're talking about a massive social change that is happening across the entire planet. You have an opportunity to capture that. You have an opportunity to use that to your advantage. Now, you can kick and scream, or you can drag your feet if you want, and you can say, yeah, look, that's all well and good, but I'll come back to it in a couple of years. In a couple of years, it's going to be twice as hard, right? So if you're not able That's okay. Do everything you can to get able. But don't freak out by people saying, oh, you got to buy before October. It's like, shut up. You should buy as soon as you can.
Yeah.
And you should be really focused on it because it's the number one priority for you and your family is to make sure that you're capturing this opportunity on all fronts. And by the way, just to your point around like we own a property company. So, is it in our interest to say that property prices are going to go up? You and I made a very strong commitment. And by the way, the receipts are there. We've been doing this podcast. We sort of took a little bit of a break from it last year, but we've been doing this podcast since 2019, right? Gabby and I. We have always said that we don't care about property.
Mhm.
What we care about is helping people create wealth and create a life of freedom, choice, and abundance. And if ever the day came that we believed that property wasn't the answer, then we would say so. Now, you may have noticed at the start of this year, we actually said we better live up to that statement and that truth because that is important to us because integrity matters. It's important for both of us. And that is why we started talking about other things. That's why we also said, hey guys, real estate's very important. And I stand by the fact that I think it's the best risk-adjusted asset on the planet, Australian residential real estate. But you know what else is important? Bitcoin. You know what else is important? Capturing part of the disruption that's happening on the technology front. These things are important. And you should be thinking about them too. And so anyone that wants to sit there and watch these videos, because I've seen people comment on previous videos of like, oh yeah, they've got a property company. No wonder they're saying this kind of thing. Like as though we're sort of doing something dodgy. Literally and it was literally on a video where I was saying, also, by the way, you should have an almost equal distribution of allocation to Bitcoin. Yeah. And like, it's like, you do realize I'm talking about 3 different asset classes here. Like, yes, we're best in class at helping people to build wealth in real estate. And I actually did a live event yesterday. I was a speaker at a wealth summit yesterday, and it was very well received and all of that kind of stuff. And there was questions like, "Oh, do you guys do commercial?" And I said, "No." Well, why not? I said, "Well, because we've developed significant market excellence in this specific area, and that matters. Like, we're not trying to be everything for everyone. Australian residential real estate, best in class. Commercial, yeah, we're looking at it, but we're not there yet, right? Development, no, same reason. And so, like, we're excellent at what we do, but there's also other things you should be thinking about. But you can't say that just because we've got a property investment company that the things we're saying aren't true. they're mathematically true. Like, this is like it. And if you want to, if you want to find excuses to not participate in the things that are happening, then that's on you. That's on you. That's on you. Because that's just you getting in your own way. That's you making up excuses and finding reasons not to take action. That's what I think.
Yeah. Yeah, I think regardless of our situation, like I think I said to you the other day, I just wish that more people who hated their job or anything about their reality, if more people knew that investing was the solution. This is kind of why I continue to do this podcast with you, because it's like, I just care about more normal people realizing that like anything they hate about their current reality, if they can improve their financial situation, it gives them more freedom and more choice
100%.
and abundance. But that's like the pathway. It doesn't matter if you know anything about it. It doesn't matter if you are a money person, if you like spreadsheets or not. It's like the pathway out of your reality right now is investing. And so the more people we can get to understand that and learn that, the more help we're going to have. Yeah, that's I'll stop there.
No, 100%. I feel exactly the same way. And you're right. So, for those of you who have been following this podcast for a while, you would have noticed that we basically did stop doing the podcast last year. And then we said, you know what? It's actually it's too important, right? This is too important. We're at a threshold. We're at a precipice now where the most important thing that people can do is invest. Is to make their money make money, to create a better life for themselves and their family. And so from a social responsibility perspective, that's why we're here. So this is why this is important to both of us, right?
Yep.
Let's tackle a couple of questions.
Should we do some Q&A?
Yeah, let's do some Q&A. There's some good ones in there. Where do you want to start?
Q&A time. Sitting on that for an hour.
Oh my God, that's awesome. That's awesome. Okay, where do you want to start with the questions?
We shouldn't start from the bottom to the top, but now we're here. Okay. What are your thoughts on how consumerism will affect the wealth transfer? Seems to me a lot of inheritance falls into the hands of people that don't need it at their life stage. Hmm.
So I firstly I don't know. Let me just say I don't know. I'm not I don't know. So everything I say is just going to be opinion and speculation, realistically.
Mhm.
But I think that there are so many people that are finding it harder to get ahead. If you gave them $10,000, they may think about spending that on something that's going to give them a good life experience. They may say,
Yep.
"Thank you for the $10,000. $10,000 is not going to change my life unless I go and do something that's going to be a life changing experience." So they may go on a holiday or do something that's going to give them, we'll call it near term joy.
Yep.
You know, like low time preference, right? So low time preference expenditure, and I kind of think that's okay, to be honest. I kind of think that's all right, because I think a lot of people are really struggling, and I think that sometimes it is just as important to embrace the beauty of the world that we have as it is to try and get ahead. So, but if you went to that same person and you said, "Hey, I'm going to give you 1.5 million," do you think they'd spend $1.5 million on a holiday or $1.5 million on a PlayStation? No, they're going to go, "Oh my God, this is my shot. This is my opportunity.
Mhm.
I could go buy a freaking house. I never thought I'd be able to buy a house." So it changes the game. So I think that I think the volume of the money matters. Like if I walk down the street today and if I found someone on the street and I gave them, you know, we're in Thailand, in case you guys don't know, if I gave someone 100 baht, they'd be like, "Wow, that's awesome. Thanks." They can go buy a snack or whatever. If I walked down the street and gave someone 10,000 Aussie dollars, they would not go to the 7-Eleven and buy snacks. They would go home and they would work out, like, are they going to put it as a house deposit? Like, what are they doing? Like,
They'd order
so
some really good snacks online.
maybe. So I think volume matters. I think
Yeah.
that the younger generation, and I say that very, very, very broadly, because the younger generation is actually probably going to be recategorized as a disaffected generation. The people that feel like they just can't get ahead. And that is no longer just the 20 somethings, that's also the 30 somethings and even sometimes the 40 somethings. So I would say that the disaffected people are seeking opportunities to try and get ahead. That's why you see a lot more sort of, we'll call it like degenerate crypto meme coin type stuff, where people are just trying to work out, they're like, so I could buy the S&P 500 and I could make 5 to 8% a year or whatever, or maybe, just maybe, let's say they've got $1,000 and they're going to make, let's call it 10% a year. Oh, okay, I've got $1,000. It's going to make me $100 in 12 months time. They're like, that's not going to change my life. But if they've got $1,000 and they go and if they can pick the right meme coin and it goes, you know, 1,000x, right? Then they've got $1 million, right? So then that's life changing. So people are seeking opportunities to get ahead. I just think it's different. That's what I would say there. So
Yep.
what do you think?
I concur. Sorry, I was more looking through the questions.
Okay, you don't have that. Just you go to the next question.
I concur. Okay, question from Blake. Downsizing for older generations. Governments should offer stamp duty exemptions. Thoughts?
What? Say that again.
Downsizing for older generations.
Mm.
Governments should offer stamp duty exemptions. Thoughts?
So I think the government should get out of the way. I think that if you offered stamp duty exemptions, that would be another way of providing additional liquidity into the market by proxy. And so I think that but I don't think that it should be there in the first place. Right. So I think the government needs to just stop doing things. I think we just need less government, less regulations. Like we have a lot of regulations in place now, which objectively I don't think we should have. Stamp duty being one of them. Like I think it's arcane and ridiculous. It's a complete joke. If you went in there today and said, right, we're just going to abolish stamp duty nationally, what would happen? Property prices go through the roof, right? So that's not a good idea. So sometimes the best idea is to do nothing, even if the thing you've got is a stupid thing, because government intervention is only going to make the problem worse. So what they could do is they could say, well, we can't get rid of stamp duty because that's just going to make property prices go through the roof. What we can do is we can take all of the stamp duty and use that to go build more houses. They could do something like that. That'd be more interesting. But I think that generally speaking, you know, we should be seeking less government intervention in things, and the free market will sort it out over time. Most of the time. Do you want me to find the next question?
Yeah, I was just looking up. I was trying to remember. I think as relating to stamp duty, I was trying to remember. I feel like in Victoria, if someone's in Victoria and in the construction industry, if you want to correct me, I believe they've like waived stamp duty for developers in Victoria as a way to like
Can't remember.
encourage, as a way to encourage development. But instead of, obviously they're not passing that on to buyers. They're just they're just adding that to the bottom line.
Yeah, so this is the problem, right? So you could say, okay, so what's the solution? So should the governments go and subsidize building companies? Well, that's one way of doing it, right? Rather than creating their own construction company, maybe they should go to all of the existing construction companies that have got really thin margins and are really struggling and subsidize them. The problem is that those subsidies would go to the top line. They would increase the property prices, right? So like it's not going to, the only actual solution is to create more supply, and you have to do that in a way that doesn't interfere with private production, right? So if you start
because demand is always there, the top line is always going to go up. Like,
exactly. Yeah, well, I mean, it's like if you provide subsidies to a private company, typically they accrete more profit. The consumer doesn't accrete more savings, right? So it'll go to the bottom line of the company, but not to the pocket of the consumer. Yep. And so the answer is not providing subsidies to private companies. The answer is let private companies sort their own shit out. Get out of the way. Stop taxing them. Stop just get out of the freaking way, right? And go build some houses. If the government wants to solve the problem, they just need to go build some houses. That's it.
Yep.
And they can be a source of immigration for them. If they want to keep the immigration levels up, they could say, great, we're going to offer jobs to people who are builders. Come in and they could create a huge construction company and build houses. And they could build thousands of houses every year and just work it out.
Yep.
Great. There's a question here from Jeremy Gilbanks, which I think is a good one. Will house price values increase uniformly in the economy, or will it focus on new development / outer ring suburbs rather than upsizer homes? So no, the house price values won't increase uniformly in the economy. So we can measure, I think we'll be able to measure roughly 3.3 to 6.6% increase in the national median house price from the home guarantee scheme. But that doesn't mean that all house prices are going up nationally. What's actually going to happen is some house prices in some locations are going to go up disproportionately more than others. And they are typically going to be in the $450,000 to $1.5 million price bracket. So that is typically going to be outer ring suburbs, major regional centers. We're looking at, you're looking for locations that have a combination of jobs, lifestyle, and relative local affordability. I actually sent the research that I've been doing on it because I was so jazzed about all this research that I was doing last night that I sent it to our leadership team, and I was like, "Oh my god, I'm just having a nerdgasm, and you got to check out this research that I've been doing." And Chen,
somebody calm me down.
I was like, "Oh my god!" I was like, "Chen, look at my data," and thankfully,
you get the hose out.
Thankfully, Chen, our head of data science and AI, who is an absolute, he's we need a nerd sound effect. I'm not sure that's a nerd sound effect. Anyway, so Chen, he was very excited by it too. Shout out to Chen. He actually went and did some research, and he's like, aha. So what kinds of suburbs is this going to actually translate to? So these are not suburb recommendations, by the way. Like I'm just highlighting the likely distribution. So for example, some candidates would be like outer west and southwest Sydney. I'm not going to mention specific ones. Central Coast, regional New South Wales, inland in New South Wales, inland major hubs as well. So like major regional centres inland of in regional New South Wales, north and west Melbourne, regional Vic. So greater major regional centres in regional Vic. So it's going to be distributed
Yeah, it makes sense.
unevenly. I'm not going to talk about specific suburbs because either we're already investing in them or we might be investing in them soon. So, so I'm not going to mention them here because it's unfair to our clients. But definitely it'll be in
Chen is the leak.
Chen's the leak.
Chen's the leak.
Yeah, so definitely it's going to be unevenly distributed, and you really got to look through the lens of jobs, lifestyle, and relative local affordability. So that's going to be the key indicator. And as we touched on at the start, like if someone's buying $1 million house, they're still going to have about $70,000 a year in holding costs on that property. So just because they can doesn't mean they will. The expected average property purchase price is about $570,000. So that should give you some indication of where the market's going to be.
Can I also tell you, I don't know if I've told you this, other condition of the policy is that you are expected, I think you're required to contribute the majority of your savings towards that 5% deposit. So you can't, like if you have 100 grand saved somehow, you can't go, I'm going to put 50 grand in and keep 50 grand. They won't let you. I don't know how they measured that, but so how you you have to start from zero again and make that 75,000 in holding costs every year. I don't understand. They're doing that to stop people who have more money from applying for the scheme.
So imagine if they spent $20 billion building homes, but they said the only people that can buy the homes are first-time buyers. Because that wouldn't impact property prices in aggregate, because they would create new supply, but only to specifically for that cohort.
Yeah.
Like that'd be a much smarter way of doing it.
I should let them know.
Yeah. All right, guys. Have we got any other questions we want to tick off before we wrap up for today?
There's this question from Dale.
Go on. What is it?
I jumped back down again. Can you see risk coming for property owners in the way of increased rates, taxes, yada yada? Risk. Can you see risk coming?
Not existentially, no.
I think costs generally in holding anything will go up over time. So I expect that they will go, and I expect governments change these kind of things all the time, right? Particularly state governments will increase land tax and stamp duties and whatever. Like the cost will probably just go up over time, but I still don't think they outweigh the benefits of being invested in the asset class.
Yeah, I think that the likelihood is they're going to find other stealth ways to get capital or to influence the economy, because people don't like taxes, right? So they may do some stuff, but I think they're going to find other ways. They're going to dress things up that look like grants, but they're actually cash grabs, or they're going to do things like this home guarantee scheme. So I don't think there's some existential. I think that probably there'll be some tax stuff that'll come along at some point, but I don't think it's an existential risk to investing in the asset class. Might be frustrating or annoying, right? But I don't think it's an existential risk. So, okay, cool. I think I'm about done.
I think we're done. You are done.
I'm done.
You're done. I am done. We are done.
Well, hope you guys have enjoyed this episode. Let us know what you think by leaving us a comment below. If you want to join the community, there is a link in the description below. If you want to work with Dashdot to scale your property portfolio and achieve a life of freedom, choice, and abundance, and you want to do that with the best possible team in the entire country and the planet to do so, there is a link in the description for you to book a time with the team and have a chat. Hope this has been useful. Hopefully you got a lot out of this. I was like a broken record there for a second. Hopefully you got a lot out of this, and we'll see you on the next episode.
Hang on. Guys, I just want to say thank you so much for the engagement today. It's been really cool. Obviously it's a topic that you're super interested in, so I really appreciate it. We love doing these live on a Friday when there's heaps of interactivity, and it's obviously something that you're really interested in. If you have liked this episode, chuck a comment on the YouTube video as well, and also share this, because again, shares for us is the main metric that we look at of was this episode really valuable, because it means that you've decided, hey, I think someone in my life should learn this and I want to share it with them, and that's really what matters to us. So if you do know anyone, share it with them. We're going to jump in?
No, no, not at all. I was going to, I agree with you. It's,
Yeah.
I agree with you. Like,
Yeah.
our number one goal with creating any of this content, and we've got lots of shit to do. Like, we're busy people with busy
We do.
lives. The reason we do this is to try and create valuable insights for you and also as many other people as possible. So if you
Yep.
found this useful and if you can help us to get this information to other people so we can impact their lives, that's it. That's the only reason we're doing it.
That's
So
it. Perfect. Otherwise, we'll see you in the community. Have a good week.
see you guys.
Bye.
Bye.